Look, I'm gonna be real with you. When I first tried to learn how to trade stocks, I wanted to throw my laptop out the window. You've got free ebooks that contradict each other, paid courses that promise you'll be a millionaire in 30 days. And don't even get me started on the scammers flexing rented yachts while selling you their secret strategy. It can feel a bit like a nightmare trying to figure out what's actually legit and what's complete garbage. I went through all of this myself and it was frustrating as hell. So I'm making this series to save you from that same headache and spare you from sifting through mountains of information, just to find your starting point. Since this is the first video, let's start with the #1 question newbies ask. How much money do I need to start trading? And my answer might just surprise you because it's not $5,000 or even $1,000. And it's not even $100 or $10. The answer is $0.
What?
That's right. The beginner's secret is practicing in a simulator before risking $1. It builds skill, kills dumb mistakes, and protects your cash. Most people rush in with real money, catch a nasty loss, and decide trading doesn't work. The thing most people miss is you're not just practicing entries, you're practicing emotions. Paper trading lets you test strategy while you learn to sit through a pullback without panic clicking like it's a video game. Here's what paper trading is: a trading simulator with live or delayed data, fake dollars, real decisions. Platforms like Webull and Pro Realtime make it simple to place orders, see fills, and review results without lighting your wallet on fire. Now here's the trick nobody talks about. Treat the fake money like it's yours. If you gamble because it's not real, you're training bad habits. That muscle memory will follow you when the dollars are real. So we create rules. Fixed position size. Pre-plan a stop loss before you click buy. No random keyboard warrior moves. Let me show you exactly how to structure your first practice block. 1 setup, 1 risk rule, 1 exit rule. That's it. Pick a simple pattern, say a breakout from a tight range. Decide your risk per trade, fixed dollar amount, or a consistent share size. Define your stop loss location, below the range for longs, above for shorts. Then run 20 simulated trades, 10 long, 10 short if your platform allows shorting. Why 20? You need reps to see patterns in your behavior, not one lucky win. And the secret sauce that turns practice into progress: record every trade, every time. Write down entry, exit, stop, reason for the trade, result, emotions, and whether you followed your rules. Use a spreadsheet, a notebook, or an app, whatever you'll actually use. This way, you can look back, see what you did wrong, and take action to immediately fix it next time. So, your homework after this video is to open a simulator account if you don't have one, like Pro Realtime and Webull, because they're free and easy to use. I've linked them in the video's description if you want to take a look. And no, I'm not getting any money for recommending these. I simply like them as a starting point. Now that you've got your sandbox, you need the language so you're not guessing when you place orders. Let's get you fluent. The market has a language all its own. Learn this, and screens start making sense. Skip it, and every button feels like a trap. The goal here is speed, clarity, and no dumb mistakes when real orders go in. Let's start with the terminology long and short. Long means you profit when the price rises, so you want to buy low and sell higher. If you buy at 10 and sell at 12, you made $2 per share before costs. Short is the flip. You profit when price falls. You borrow shares, sell them first, then buy back lower. Sell at 10, buy back at 7, you keep the difference. The catch? A stock can rise more than 100%, so short risk can balloon fast. And here's a memory trick. Long up, short down. If you remember nothing else from this part, lock that in. Now bulls and bears. For bulls, you should think up, and bears, you should think down. An easy way to remember this is that bull horns go up when they charge. Bear paws rake down when clawing at you. But here's the real lesson. Don't marry a side. Be opinion light, evidence heavy. Trade on what's happening rather than what you hope to happen. One day, you'll be bull on one ticker, bear on another, and flat on the rest. Remember, the pros switch hats fast. Next up, let's talk through the bid, the ask, and the spread. The bid is the highest price buyers will pay right now. The ask is the lowest price sellers will accept. The spread is the gap between them, and that gap is a hidden cost. Tight spread? You get in and out clean. Wide spread? You can be down the second you click buy. Here's an example. Say the bid is $9 and the ask is $10. Then the spread is $1. If you market buy at $10 and immediately try to sell, the best bid is still $9, and you're down $1 per share before the stock moves a tick. In small caps, spreads can be much wider and jumpy. That's a slippage risk. Respect it. Here's a quick checkpoint. Every time you glance at a chart, also glance at the spread. It takes 1 second and can save you from "why am I instantly red" syndrome. In liquid names, spreads are pennies. In thinner names, they can be nickels, dimes, or worse. If you're learning, pick tickers with tight spreads so your education isn't taxed by spread. As you get more familiar with the bid and the ask, you'll notice they're represented in the moving wall of numbers you see on pro streams. This is called Level 2 data. On the left, stacked bids at different prices and sizes. On the right, stacked asks. It shows depth of interest where buyers and sellers are waiting, and the amount between those two numbers is the spread. How do you use Level 2 without getting faked? Filter first with structure on the chart, trends, ranges, clear levels. Then use Level 2 to fine-tune entries and exits near those levels. If you're taking a breakout above a well-defined range, a thinning task and steady prints through the level support your trade. If the spread suddenly widens and size vanishes, pull your order. Conditions changed. The thing most people miss is that Level 2 confirms your plan. It shouldn't replace your plan. Now that you can speak the language, it's time to push the right buttons by looking at some basic trading orders. Orders are the switches that turn ideas into trades. Use the wrong type, and you'll get bad prices, missed fills, or no protection. Use the right type, and everything clicks. Let's start with the blunt instrument, the market order. You're telling your broker, get me in right now at the best available price. Pro, near instant fill. Con, you pay the spread, and whatever slippage comes with a fast move. That's why market orders are fine for highly liquid names or urgent exits, but they're dangerous in thin stocks with jumpy spreads. Think of it like hailing a cab at surge pricing. Convenient, but not cheap. Now let's flip it. A limit order says, only fill me at this price or better. If you set a buy limit at 10, you'll pay 10 or less. The pro is price control, and the con is there's no guarantee you'll get filled. Price can tease your level, skip you by a penny, and rip away. That's normal. Limit orders are your go-to for patient entries and for taking profits at planned levels. The mistake most beginners make is chasing the fill, canceling and replacing higher 5 times until it basically becomes a market order. Don't do that. If the market runs without you, your plan wasn't early. It was wrong or late. You'll live to trade another setup. Now, let's look at the stop order. This one enters you only if price reaches your trigger. Use a buy stop above price to catch a breakout. Use a sell stop below price to catch a breakdown. The pro is you let momentum prove itself before you commit. And the con is gaps and fast moves can jump over your ideal entry, and you'll get filled at the next available price. Then there's the stop loss. It exits you when you're wrong. You set a line in the sand. If price hits here, I'm out. It protects you from the "I'll just hold" spiral. But if it's too tight relative to normal volatility, you'll get wicked out constantly. Use structure and ATR to give the trade room. And here's the rule tattoo. Never move a stop further away after you're in. You can move it tighter as the trade works, but you don't loosen damage. The more you grow as a trader, the more advanced you'll get and use more conditional orders, but this gives you the foundation. And that's it. Congratulations. Now that you've knocked out part 1 of how to start trading as a total beginner, remember, only bet what you can afford to lose and keep it boring and consistent. Review notes, tag mistakes, and make corrections as soon as you see them. And continue refreshing and studying terminology and getting more and more familiar with the different trading orders. Don't forget to like and subscribe to the channel to keep up with the latest videos in the series.